This is Eric Johnston, one of the most bullish investors on the street. For the record, he was bearish like 2 weeks ago.
So we're very bullish and our conviction is very high. And so what has changed? Inflation real time is falling sharply. Every single data point in inflation is falling month over month. Finally, home prices are finally running over.
Stick around, because I'm going to bring you more experts, more data, and more charts, because this is what happened in the market. Welcome to For the Record. I'm your host, Jay Fielder. Let's get into it.
When is the Fed going to pivot? Your best guesstimate, if you had to pick a month, gun to your head, last rate rise November.
We think the Fed's last hike is going to be December 14th. So we're a mere 2 months away from this Fed hike cycle being over. When this market gets a whiff that the Fed is almost done, the first reaction is that we are going to have a sharp rally. You had the VIX hit 34. You've had the RSI go well below 30.
Eric Johnston is pretty bullish, and he's pointing out technicals, which are probabilities and correlations that say the market should bounce. When the VIX is above 34, the market bounced. When the RSI becomes oversold, the market bounced.
You want to be a buyer, VIX north of 30 for those snapback rallies. Anybody that listened to that and I started to actually take action based on that in my own portfolio, and it just happened again. Last week.
That's right.
VIX 34 print, and it didn't matter how you felt. That was the moment to find something and buy it.
There's been 4 times when the CPI has gone above 6%. When it starts to fall, markets V-bottom every time. It happened in 1970, 1975, 1980, 1990, and these were V-bottoms. So the market is going to smell inflation is done, Fed is done, and the first reaction is going to be market rallies.
Historically, when inflation got above 6% and started to roll over, the market bottomed.
Ultimately, we are going to have a very sharp 3-month rally, and we want to call it. This call, I would say, is very high conviction. I feel very strongly that we are going to see this rally because everything is lining up across the board.
But this is one investor's opinion. Let's see how the market reacted on Monday. On Monday morning, the ISM's PMI survey hit a 2-year low, and the market exploded. Because this is what the market wants to see, slower growth to slow inflation. The ISM's PMI survey represents business activity and economic growth, and if the survey continues to slow, then growth slows, and if growth slows, inflation slows. And if inflation slows, this means the Fed's policy is working. Therefore, they can slow down increasing interest rates. We also get some confirmation from the Fed. Fed Williams reports rate hikes have been very beneficial. Tuesday morning, job openings come out much weaker than expected, and this means there's less jobs being created, and the market rallies. Then, Fed President Mary Daly comes out to say she expects unemployment to rise to 4.5%. Now the market rallies higher because less jobs, higher unemployment means lower growth, which leads to slowing inflation. So the market rallies. Now for the second day in a row, the RSI trades above 70, signaling strong buying pressure. And now investors are starting to get bullish.
So I do expect that we'll see some follow through between now and probably the middle part of December. Any sort of pullback, in my view, likely is going to be a chance to buy. And a lot of this has to do with interest rates and the dollar finally starting to show some evidence of weakness. In general, people are too bearish. I'm hoping to get pullbacks to buy into, honestly.
Now, Fundstrat's Mark Newton believes you should be buying every pullback because the dollar and interest rates have actually peaked. A strong dollar and high interest rates push down assets, so if they roll over, markets go higher. Now, the market moved up strong Monday and Tuesday. So did the dollar and interest rates go lower Monday and Tuesday? Wednesday morning, private payrolls came in stronger than expected, and the market sold off. But then the ISM services came in weaker than the previous month, and the market bounced exactly at Tuesday's open. Now, Fed President Mary Daly gave an interview on this day, and by the time it was over, the market was reaching new highs.
Are you going to pivot? Is the Fed going to change its rate path because the markets are nervous?
Us, the path has been very clear. We're going to raise the rate until we get into some restrictive territory, and then we're going to hold that rate there. We haven't pivoted on that.
The feeling is the Fed raises rates until something breaks. Are we close to anything breaking?
So we definitely don't raise rates until something breaks.
Although she talks about raising rates and holding them there, she promises not to break the markets. She also mentions data dependence, which suggests if economic data comes out weaker than expected, they can pause. And this is what the market wants to see. If things get too bad, will the Fed pause?
Yesterday's JOLTS report confirmed what they've been telling me. Monetary policy is working, the job market is slowing. Of course, we're eagerly awaiting that CPI number. I'd like to see core prices either stay flat or come down. You know, the inflation not go up. Last time we had a surprise, it went up, not down. And you know, I'm looking for that core number to really start to even out and come down.
Now, although inflation as a whole is going lower, core inflation actually ticked higher this month. Core inflation is basically everything minus energy and minus food. So the Fed's signaling to the market they're paying attention to the core inflation numbers. This is Fed President Kashkari, and he believes the Fed's a long way away from pausing rate hikes and that they should continue to shrink the balance sheet, which means they should continue removing cash from the system. Now, this is Fed President Evans, and he's nervous about core inflation, and he suggests over the next 2 meetings the Fed should hike 1.25%. Now, the Fed sets expectations, and all this worry and talk about tightening markets maybe has the market nervous, but some investors believe we're close to a pivot.
For the first time in history since the Great Depression, M2, the broad definition of money, is actually contracting, and the pace at which the Fed and other central banks are removing accommodation is beginning to spill over into the financial markets, because I think the market is going to force a pivot on them, and I think we're only weeks away.
It's possible that you get one final sharp panic over the next 2 weeks, and pivot, for me, just stop. Once you stop, I'll call that the pivot.
The unemployment rate is one of the most powerful signals to the market, and unemployment went lower. This is not good, and the market got crushed because it signals growth, and growth doesn't help with inflation. But maybe the market overreacted. Not all the employment data supported growth. Non-farm payrolls went lower, manufacturing payrolls went lower, government payrolls went lower, and labor participation went lower. But maybe it was the breakout in oil that drove markets lower, which poses a bigger risk to inflation. See, higher production keeps prices lower, and OPEC, one of the biggest producers of oil, cut production earlier this week, and ever since, oil prices have been rising.
Today, the worldwide cartel that controls almost half of the world's oil production plans to cut production by 2 million barrels.
And watch out, this move could actually send gas prices back up.
Everything has a price. Energy security has a price as well.
You know, our priority now is stabilizing market. Now, we could be accused of wanting to influence market in a negative way. That's everybody's prerogative.
So will oil prices go back to the highs, or will this be short-lived?
And Damien, let's just break down this OPEC Plus meeting today. Brian pointed to this. There's all these questions about what just happened. 2 million barrels per day cut, but that's a technical issue, closer to 900,000 barrels per day. What's that going to do to the market?
This is quite bullish, right? This is going to take inventories from record low to even lower level and set the stage, in our view, for a large rally in prices at the end of this year. So, for us, very much a bullish outcome for the oil market.
They are doing a supply cut. Lower supply leads to higher prices. However, higher oil prices leads to a weaker economy, which leads to a drop in demand. So
the forces at play in the oil market are reduced supply and reduced demand. I said that demand would overwhelm the supply issues, and that's been true. Oil price has been coming off from 120, got down to 70 something last week. Rebounded. Why? Because the Saudis like, no, you, we're going to put up the price of oil again. And Biden's like, no, we're going to sell our oil from our SDR. We've got this fight going on, this geopolitical fight about what is the fair value price of oil. Obviously, the markets aren't allowed to set oil. If you think the interest rate markets are crooked by the central banks, meet OPEC. The question is going to be, okay, if we get a recovery now, what happens to the price of oil? Well, if economic growth comes back now, well, then oil is going higher. If I'm right and economic growth continues lower for the next 6 months or so, and sharply lower, then we'll have eroded enough demand in oil that it won't come back as fast. Now, what really matters for inflation is the rate of change of oil. Does it get back over $120? I don't think so. It's possible. But if it does it has to do it slower. If it does it slower, then the rate of change in inflation won't come anywhere near here.
The markets are hanging on by a shoestring. If the dollar and interest rates break higher, expect a crash. But this all depends on Thursday, October 13th. Can inflation get under 8%?